Hi friends, welcome to the channel JIV and CIV Made Simple. In this lecture we are going to discuss our unit number 14 of ABFM, and the chapter name, as you can see, is discounted cash flow valuation method. So let's start with this topic with what are the topic which we have to study in this chapter. We will see the introduction, we will see how to estimate the inputs, that is 14.2 number topic, right? So introduction, first of all we will see estimating inputs, approaches to DCF. So this, in short, it is called DCF, right? So what are the approaches to discounted cash flow methods, various discounted cash flow models, dividend discount model, we call it DDM, and finally we will see the applicability of the DDM. So these are the six topic which we have to go through. So let's get started with our first topic. So as you can see, this lecture is completely in English. So friends, we are unlocking one of the most powerful tool in finance, which is called DCF, discounted cash flow valuation. Sound fancy, right? But don't worry, I will break it down into simple terms so that you can master it with ease. Imagine that you are buying a rental property, right? Imagine that you are buying a rental property, right? You don't just look at the price tag, you think about how much rent it will bring in over the time. The same logic applies to valuing business and investment. So whenever you are thinking about this rental property, so you think how much rent, right? You think about how much rent it will bring over the time. So the question is, why is DCF important, right? Let's answer this question. Why is DCF so important, right? So DCF valuation is the foundation of all the valuation method. Even if we compare company based on market trend, right? So you have heard about this relative valuation. So basically when I say relative valuation, what we are doing, we are comparing company based on market trend, right? So we are comparing, just let me write down, we are comparing company based on market trend. So even if we compare company based on market trend, we still need to understand DCF first. It's like it's like learning addition. It's like learning addition before moving on to algebra. Obviously, if you want to learn algebra, you must learn addition. So that is why relative valuation plays a very important role. Even if we compare the company based on market trend, we still need to understand DCF first, right? So that is why it is written that relative valuation requires an understanding of DCF valuation, right? So question is, what is the core idea behind DCF? So let's answer this question. The first of all question is core idea, right? Core idea behind DCF. So what is the core idea behind DCF? So it's all about the present value, right? So whenever I say DCF, it's all about the PV. PV means the present value, right? So money today is worth more than money in the future. So this is called present value. You know it very well that money today is worth more than money available in the future because of the risk and opportunity cost. Two things are there. The first thing is the risk, second thing is the opportunity cost. Because of these two things, money today is more worth than in the future, right? So when we calculate an asset worth, we don't just add up all the future cash flow, we discount them to today's value. So remember, whenever we calculate an asset worth, we don't just add up all the future cash flow, we discount them. Discounting, you have heard about the discounting. So suppose these are your future cash flow, right? So let me give you some example of discounting. How does it work? So let's suppose these are your future cash flow. We discount them to the present value. We discount all of them to their present value, right? So because of the risk and opportunity cost, so what we do that whenever we calculate an asset worth, suppose we want to calculate what is the worth of an asset, right? So what we do, we don't just add up all the future value, rather we discount them to the today's value. And there is something called risk and discount rate. So what is the link? So here let's talk about this point, right? So DCF valuation is grounded in the concept of present value, just now we are talking about. So the next question is risk and discount rate, how they are related. So friends, what is the link? So some risky asset like a startup or volatile stock need higher discount rate. There are some risky asset like let me give you some example, like suppose a startup is there, or suppose I say volatile stock is there, right? Volatile stock is there. So some risky asset like a startup and volatile stock, they need high discount rate, right? They need high discount rate, right? Meaning we can reduce their future value more. So please try to understand, if their discount rate is high, so then it means that, so basically what we are doing, this is our future value, we multiply this future value with the discount rate, we will get the present value. So you can see, if discount rate is higher, right, so it means that we can reduce their future value more, right? So this PV will be more, right? So safer investment like government bond have low discount rate. You must know it, that a startup, volatile stock, they have high discount rate. That means we can reduce their future value more. If discount rate is higher, actually Actually, you know what will happen. So basically, discount rate, when I say which is 1 upon 1 plus r whole to the power n, right? So it is mathematically represented like this: 1 upon 1 plus r whole to the power n. And since we are talking about rate, so it means r. So it means r. So if r increases, so this entire term will decrease, and you know this PV, this present value is equal to future value multiplied by dr. So if dr increase, so obviously PV will also decrease. So we can see easily that if we increase the discount rate, since this startup and volatile stock have high discount rate, it means their present value will be less. And if we talk about some government bond, right, let me give you some example. If we talk about some investment like government bond, or suppose so they are the safe investment. So these government bond, you know, they are the safe investment, and that is why their discount rate is low. Their discount rate is low. So it's like lending money to a friend. You will charge more interest to an unreliable friend than to someone super trustworthy. Obviously, suppose you are lending to your friend, so you will charge more interest on unreliable friend rather than to someone who is super trustworthy. Similarly, a startup and volatile stock have high discount rate, and government bond have low discount rate. So I hope it is clear. So that is how risk and so our question was what? How risk and discount rate are, what is the linking between them? Now it is clear. So if risk is higher for this thing, discount rate is also higher. Risk is lower, discount rate is also lower. Now let's move forward and let's discuss about something called intrinsic value. What is the meaning of intrinsic value? Which is the true worth. So when I talk about intrinsic value, this is called the true worth of a company. Let me explain. You know, DCF help us find the intrinsic value of an asset. Means when I say intrinsic value, this simply means real value. Intrinsic value simply means the real value, right? Real worth or real value, whatever you call it. So intrinsic value help us calculate the real worth of an asset. Means it's real worth based on fundamental factors. You know, there are something called fundamental factor. So based on this fundamental factor, this intrinsic value tells us the real worth. So not just the market thing. So this is super useful, especially for valuing young company. This intrinsic value, you know, it is super useful, especially for valuing young company, right, where market price fluctuate widely. So the bottom line is that no matter which DCF model we use, the principle stays the same. Understanding this concept will give you a solid edge in financial analysis and decision making, right? So I hope intrinsic value we have talked about, DCF valuation we have talked about, right? We have also talked about how risk and discount rate are related. What is relative valuation? The foundation of relative valuation lies in DCF, and DCF is all about the finding the present value, right? Let's talk about more. So now let's move forward to, let's discuss the estimating input for DCF valuation. Let's talk about it now. So friends, in the last slide we cracked the basics of DCF. Now let's go into the key ingredient that make DCF work. Think of this like cooking your favorite dish. You need the right ingredient in the right proportion to get the perfect flavor, right? That is how we are going to discuss. So friends, let's talk about the predicted cash flow, which is the core ingredient. So the core ingredient is the predicted cash flow. Imagine you are buying a shop. Right? So you will want to know how much profit it will make in the future, right? So you must be interested in knowing the profit. So that is what we call predicted cash flow. So this is called predicted cash flow. This is what we call predicted cash flow. The more an investment is expected to generate over the time. The money. What is the meaning of predicted cash flow? It simply means the money and investment is expected to generate over the time. And you know, if you talk about the equity investor, it could be dividend. It could be dividend, or it could be, you know, FCFE. What is FCFE? FCFE stands for, you know, free cash flow to equity. You see it written here, free cash flow to equity. For equity investor, it could be dividend or free cash flow to equity. Like, you know, cash left after paying expense and debt. And what is dividend? Dividends means money paid to shareholder. Whatever money is paid to the shareholder, this is called dividend, right? So for equity investor, this predicted cash flow, it can either be dividend, right? Dividend means money paid to shareholder, or it can be, you know, FCFE. FCFE means free cash flow to equity, which means cash left after paying expense and debt. So the more accurate your prediction, the better your valuation. That's the point, right? So what we have just talked now, that imagine you are buying a shop, you will want to know how much profit it will make in the future, and that is what we called predicted cash flow. You are interested in the predicted cash flow, right? So means the money and investment is expected to generate over the time. That is called predicted cash flow. And So suppose our investment is it could include for equity. Suppose an equity investor is there. So he is investing in equity. So what will be the predicted cash flow for him? It could be either be dividend, right, which is money paid to the shareholder, or it could be FCFE, that is free cash flow to equity, which means the cash left after paying expense and debt. So the more accurate your prediction is, the better your valuation will become. That is the point. So I hope the concept of predicted cash flow is clear now. Now let's move over to the next point, which is the discount rate. When I say discount rate, it means adjusting for risk. Not all investment are created equal. Some are safe. So let me give you some example of safe investment, like FD, fixed deposit. This is a safe investment, right? But some are risky. So let me give you some example of risky one, like you are investing in a startup. So investing in a startup is quite risky. So the discount rate help adjust for this risk, right? So this risk gets adjusted by the discount rate. So simple rule is that high risk, if risk is high, so DR will be high. I have told you earlier. And if low risk is there, it means DR will be lower, right? Discount rate will be lower. So high risk means high discount rate, means we discount future cash flow more, and low risk means lower discount rate, means as the cash flow are more certain. Since the cash flow is more certain, that is why they have less discount rate. Think of it like lending money to two friends. One is super responsible and other is always broke. So you will charge the risky friend more interest, right? That is exactly how discount rate work. So I hope this is clear now. We have talked about it earlier also. The next thing we have to discuss is the cash flow growth rate. The future matters, right? We don't just look at today's number. We estimate how cash flow will grow in the future. So basically, we will estimate how cash flow grow in future, right? How cash flow will grow in the future. So a growing company like a new tech startup may have high growth, while a well-established bank may have a steady growth. So getting this right is crucial for realistic valuation. So basically, if we talk about this cash flow growth rate, this point we are talking about, this one, it simply means that we don't just look at the today's number. We estimate how cash flow will grow in the future. Obviously, cash flow, how it will grow, right? I've given you two examples. So suppose there is a tech startup company. Suppose there is a new tech startup. It may have high growth, right? It may have high growth, while a well-established bank may have a steady growth. So basically, getting this right is very crucial for realistic valuation. And then finally, we look at the growth pattern. Here you can see growth pattern. What does it mean? That this is the big picture. Growth is not always smooth. It can be fast at first and slow later, or vice versa. So understanding how an asset cash flow grow over the time help us predict its future earning more accurately. So understanding the growth pattern means how the growth how an asset cash flow grow over the time. So basically, what is the meaning of pattern? We are understanding asset cash flow. Basically, we are understanding asset cash flow means the growth of asset cash flow. Basically, understanding how an asset cash flow grow over the time, it helps us predict its future earning more accurately. That is called the growth pattern. So the final thought is that if you can master these four input, what are the four input? The first is the cash flow, second is the discount rate, third is the cash flow growth rate, and fourth is the growth pattern. If you master these four input, you will have the ultimate toolkit to evaluate any investment like a pro. Right, you can invest any input. So basically, these are the input which are required for DCF valuation. Remember it. I have told in detail about these things: predicted cash inflow, discount rate, cash flow growth rate, right, growth pattern. So understanding these patterns, all these four input will help you evaluate any kind of investment like a pro. So coming up next, we will apply this concept in a real world DCF calculation. Right. So let's get started. So I hope everything is clear till now. Please hit the like button if you really think that whatever I am teaching you is going into your if you're grasping them clearly. Now let's talk about the expected cash flow here. Let's talk in detail. So friends, that if we are breaking down two crucial elements, first is the expected cash flow and second is the discount rate. So expected cash flow means basically what is the meaning of this expected cash flow? Means first it answers the question, what are we actually valuing? What are we actually valuing? This is the question. Think of an investment as a money machine. It generates cash over the time. But how do we measure this cash flow? So here are three types. The first, question is how do we measuring this cash flow? This is the point. Measure cash flow. How do we measure this cash flow? So the first is the dividend. You know what dividend? So if you own share in a company, dividend are the cash payment made directly to you as investor. So suppose you own share in a company. right? So dividend is what? Dividend are the cash payment made directly to you as an investor. Since you as an investor, you are an investor, so you directly get some cash flow, and that is called dividend. So this is the simplest and the most direct way to measure cash flow. So this is how we measure cash flow. Second way to measure cash flow I have already talked about earlier is FCFE. As an equity investor, you get FCFE, that is free cash flow to equity. So basically this is the money left after a company paid debt and reinvest for growth. So suppose company has paid all its debts and company has reinvested for growth, and whatever money is left behind is called FCFE, right? It's like your salary after paying bill and saving for the future expense. Investor use FCFE to assess how much cash is truly available to the shareholder, right? So company has covered its debts, company has given some amount for reinvestment for growth. After all this thing has been done, whatever is left behind is called FCFE, right? This is called free cash flow to equity. So investor use this FCFE to assess how much of the cash is truly available to shareholder. Then we have something called FCFF, that means free cash flow to the firm. So basically this is your total cash flow available to everyone, right? Total cash flow available to everyone. When I say everyone, it includes shareholder, right? It may include lenders, it may include preferred stockholder. So basically FCFF means free cash flow to the firm, which means total cash flow available to everyone, shareholder, lender, preferred stockholder. You can calculate it by adding FCFE to the cash paid to lender and preferred stock. How do you calculate FCFF? So you have FCFE, right? Let me show you the formula to calculate FCFF. So what you will do, first of all you write here FCFE, and then you add, what you add? You add, right, cash paid to lender, cash paid to lender plus preferred stockholder, right? So cash flow to the lender and preferred stockholder, if you add to FCFE, this will give you FCFF. So what is FCFF? It means total cash flow available to everyone, stakeholder, lender, preferred stockholder. So FCFE is all about shareholder, right? We have talked about it. It is the cash flow available to the shareholder, but we have to add the cash flow to the lender, we have to add to the cash flow to the preferred stockholder, and then we will get FCFF. Means total cash flow which is available to all the claim holder, like lenders, preferred stockholders, and FCFE, right? So why does this matter? Because different valuation models use different type of cash flow, and if you are valuing a company from a shareholder perspective, right, FCFE is the key. But if you are looking at the entire company value, FCFF is the way to go. So basically depending on from whom perspective you are valuing. If you are valuing a company from just shareholder perspective, from just investor perspective, this is great. But if you are valuing a company from the entire, if you are looking at the entire company value, then you have to take help of this so-called FCFF, which we call as free cash flow to the firm, right? So I hope this makes sense to you. So friends, just now we have talked about the three key types, right? Expected cash flow, dividend, FCFE, and FCFF. Now let's switch our focus to our next topic, which is discount rate, right? Discount rate. Let's talk about it. So imagine someone promise you to give ₹1,000. Someone promise you to give ₹1,000 in 5 years. Would you consider it equal to ₹1,000 today? Of course not. The value of money decreases over the time due to risk and opportunity cost. So two factors are there. The first is risk, and second is called opportunity cost. Sorry friends. So because of this risk and opportunity cost, the value of ₹1,000 after 5 years will not be the same as today. So the discount rate is the cost of waiting for money in the future. So what is the discount rate? It simply means the cost cost for waiting. You are waiting for money, right? You are waiting for money in future, right? This is called the discount rate. So here is what influences it. You know it very well that high risk cash flow, right? High risk cash flow, it means high discount rate, and low risk cash flow is equal to low discount rate. Think of a stable government bond. Now let's talk about this default risk. What is the meaning of this default risk? And cost of debt. So what happens when you can't pay? That is called default. Obviously you know it, right? You know it very well. What is the meaning of default? When you can't pay, it's called default. So default risk and cost of debt. So have you ever taken a loan? Have you ever taken a loan? Then you know about this default risk, the chance of not being able to repay. The higher the risk of default, the more interest a lender will charge. Obviously, if you continue defaulting, right, means the higher the risk of default, the more default risk is there. What will happen? The more interest rate a lender will charge, right? So this interest rate is called the cost of debt. What is the meaning of cost of debt? So this interest rate is called the cost of debt, right? So this is the point. And you know, interest expense are tax deductible. Yes, very important point. So whatever interest you pay on this loan, they are tax deductible, means you can show the deduction in tax, right? They are tax deductible. So interest expense are tax deductible, which means company often pay less tax on borrowed money, making debt cheaper in the long run, right? Because they pay less tax. Some tax are deductible, right? Means they can get rebate on the tax they have paid based on this interest expense. So that's why how that is, so what is the final thought? The final thought is that it made cost of debt cheaper, right? So expected cash flow tells us how much money an investment generate, while the discount rate help us adjust for risk and time. Get these two right and you are on your way to valuing investment like a pro, right? So I hope it is clear now what is discount rate. And we have also talked about, you know, we have talked about sorry, what are the methods of generating cash flow? Just now we have talked about three methods: dividend, FCFE, FCFF, and just now we have talked about the discount rate. I hope this is clear to you. Now let's move forward and let's see the next point, right? So here it is, risk measures on key points on risk and discount rate. Okay, so here is the point. So risk measure for equity are derived from variation of return, right? And consensus is reached in model on fundamental areas. So you know, risk needs to be perceived through the perspective of the marginal investor who is likely diversified. And you know, the non-diversifiable or market risk should be used to estimate the discount rate. These are the important points. Now let's talk about the expected return on investment is calculated. How it is calculated? So you start with a risk-free return, you add a premium proportional to the degree of market risk, and then you will get the expected return on investment, right? Now here is the point, cost of capital. How the cost of capital is determined? So friends, we are cracking the code on cost of capital. This is what we are discussing now. You know, this is an important critical concept in finance. If you have ever wondered how company decide the cost of raising money, so this slide is for you. So the first question is, what is the meaning of this so-called cost of capital? Imagine you are starting a business. Let me give you an example to make it clear. Imagine that you are starting a business, right? So to grow you need money. You have two choice. Either you take the debt, means take a loan, but you will have to pay interest to the lender, or you bring in investor, which we call equity. These are the two methods through which you can raise money, right? But for equity, you know, the investor will want a share of your profit. So the cost of capital is simply the average cost of raising money through both debt and equity, right? Average cost of raising money through both debt as well as equity, right? So let me give you the formula for it. You can see the cost of capital formula. Let me write down. Cost of capital is equal to, you know, cost of equity multiplied by weight of equity plus post-tax cost of debt multiplied by debt weight. So CE means cost of equity, CD means post-tax cost of debt, WE and WD represent the weight, right? Means equity weight and debt weight. So this formula will help you calculate the cost of capital, because you know, capital can be generated by either raising equity or debt. So what we do, we find their cost of equity, we find their cost of debt and multiply it by their respective weight, right? That will give us the cost of capital. This is how we do it. Now the question is, how do we decide the weight? Yes, in the formula you might have seen WE, you might have seen WD. So the question is, how do we decide? How we decide it? So here is the point. Let's try to understand. So the weight depends on how much money come from debt versus equity. And here is the trick. We don't use book value, we use market value, right? Book value is not used, you use the market value. Now you must know what is the difference between the book value and the market value, right? So you know, we don't use book value, rather we use market value while calculating the weight, right? That is because investor look at what the company is worth today, not what is worth on the paper a year ago. Simply book value means what was the worth of company when it started, which was a year ago, right? Year ago. And market value means today's market value. So basically we look at this market value, not this book value. Reason is that investor looks at what the company is worth today, not what it was worth on paper a year ago. Let me give you an example to make it more clear. For example, if a company is 60% funded by equity, right, and 40% funded by debt, right, then its cost of capital will be a weighted average of these two sources. So we look at the present market value, right? Very important point. Now let's talk about the role of discount rate in role of risk in discount rate. Already we know it very well that here is where the things get interesting. Risk matter. So if we talk about the cost of debt, right, if we talk about the cost of debt, let us take into consideration how discount rate is taken into consideration. So if we talk about the cost of debt, or we call loan money, whatever means, simply means the loan money, right? So loan money, so lender worry about something called default risk. Lender worry about default risk, the chance that a company won't pay back its loan. That is why they charge a default premium. Company charge a default premium, means higher interest for riskier business, right? Again I am repeating, when I say cost of debt, what does it mean? It simply means lender worry about default risk, right? Means the chance that a company won't pay back the loan, and that is why the company charge a default premium, higher interest for riskier business. If a business is risky, so higher premium will be charged. So cost of debt include a default premium, right? So default risk is covered in the form of premium which they charge. And if you look at the cost of equity, right, if you look at the cost of equity, so let me show that also. So investor expect higher return, right? Investor expect higher return if they take on higher risk, and this is called equity risk premium. Right? Means basically it is a reward for taking a chance on the company's success. So now the big challenge is that that how do we measure? So what make it tricky? How do we measure default risk? Yes, this is a very big challenge, right? How do we measure default risk? Lender estimate how likely the company is likely to fall. How do we estimate equity risk? Investor expect more return if the company operate in a volatile or uncertain industry. So what is the final thought? That cost of capital is the price a company pay for using other people's money, either through loan or selling share. It is crucial in DCF because discount rate must reflect the riskiness of the cash flow, right? So in the upcoming slide we will see how all these factors come together to calculate the perfect discount rate, right? So let's switch our focus to estimating future growth. Let's discuss it now. Estimating future growth. So if the point till now is clear, please hit the like button. Now let's talk about it. So friends, we are diving into estimating future growth, one of the trickiest yet most important part of the DCF valuation. Let's go. So why do we estimate future growth? First of all, the question is why future growth? Why? Let's answer it. When we invest in a company, we want to know how much will it grow in the future. Obviously, we want to know how much it will grow, right? So this help us predict the cash flow. The answer is it help us in predicting the cash flow, right? It help us in predicting the cash flow. That's why we need to estimate future growth, right? So this cash flow, it is just like a backbone. This is just like the backbone of valuation. So to do this, we need to estimate what? We need to estimate the revenue growth, right? The first thing we need to estimate is let me write down. We need to estimate the revenue growth, means how fast will the company earning increase. And second thing, basically what we are trying to estimate, the growth, future growth. So for that we will need to estimate revenue growth, which means how fast the company earning will increase. And second thing we need to look at is the expense growth. Expense growth means will cost rise faster or slower than revenue. So the trick is that finding the right balance. That means finding the right balance. What is the meaning of right balance? Which means overestimating growth can make an investment look better than actually it is, while underestimating can make a great opportunity seem weak. So we should neither overestimate nor underestimate. This is the key point, right? So if you overestimate, what will happen? If you overestimate growth, it can make an investment look better than it is actually, and while underestimating, it can make a great opportunity seem weak. That's the point, right? So revenue growth, expense growth, you must understand it clearly, right? So that is the point. Okay, so I hope it is this line is clear now, right? So need estimate for predicted growth rate of revenue and expense to project future cash flow. Now let's talk about the role of inflation. Role of inflation in the growth. Basically, we are interested in estimating the future growth. Let's talk about how inflation plays a role in the growth, right? So we come to know that inflation affect everything from your grocery bill to business profit. If prices are rising at 5% per year, let's say price are rising at 5% per year, but a company revenue is only growing at 3%. But company revenue is only growing at 3%. So it is actually losing value in the real term, right? Because price is rising at 5% and revenue is just rising in 3%, so obviously it is losing value. So the key insight is that growth in cash flow should match or exceed expected inflation, right? So that is the point. Growth in cash flow, it should match. So cash flow growth should be greater than or equal to rise in the inflation. This is the point. And in booming industry, growth outpace inflation, right? In booming industry, here you can see, let me show you, right? In tight real estate market, so there are some market where growth outpace the inflation. Let me give you some example. So in booming industry, growth, you can see that growth outpace, right? Growth may outpace inflation. For example, tight real estate market means high rental price. When real estate market is tight, it means rental price will be high, right? High rental price. And in a struggling sector, growth lags behind inflation. For example, high vacancy rate, low rental income. So we need realistic growth projection that reflect the overall business environment and economy, right? So that is why we need realistic growth projection that reflect the overall business environment and now the pertinent question is, how do we estimate growth? Now that we know how inflation affect the growth, now that we know that what is the important role of cash flow, and that too revenue and expense side, right? We need to estimate for predicted growth rate of revenue, predicted growth rate of expense, right? Revenue growth, expense growth, right? So finding the right balance. So basically truth factor we have just discussed now. Now the pertinent question is, that how do we estimate growth? So since the future is quite uncertain, you know it very well that future is uncertain, right? So analysts use three common methods to estimate the growth. What are the three common methods used? The first method they use, is look at the past. Let me write down. Look at past. What does it mean? We analyze a company historical growth rate to see how it performed over the year. But wait, past performance does not guarantee future success. You must remember it. So what I want to say that past performance is not equal to future growth, right? Past performance does not guarantee future success. Market change, competition increase, economic conditions shift. So look at the past. So basically what we are talking about, that how to estimate the growth. So three common methods. The first method I have told you is to look at the past. But the point is that we analyze the company historical growth rate to see how it performed over the year. But past performance, it does not guarantee future success. That's the point. Market will change, competition will increase, economic condition will shift. So it is not a foolproof method to see the growth. Second way to look at is the industry and economic trend, right? So historical I have told you, right? And second method, let me show you here it is. Second method to look at, here it is industry and economic trend. So we check whether industry is expanding, stable or declining, right? So we check at the industry whether it is expanding, whether it is declining. We look at this factor, right? For example, a tech company in AI, artificial intelligence, might grow much faster than a brick and mortar retailer. And third thing is company specific factor. There are some factor which is specific to company, right? This we have to take into consideration. So first point, past growth. Second point, just now we are talking about industry trend. And the third point is company specific factor. So we assess the company innovation, leadership, expansion plan, market demand. A company launching a new breakthrough product could see exponential growth, while one relying on outdated technology might struggle. So the big challenge is still the same, predicting the future. Analysts face huge uncertainty while forecasting growth. The key is to be realistic, not overly optimistic or not too conservative, right? So instead of relying on just one growth estimate, a smart analyst could consider multiple scenarios like best case, worst case, most likely case, right? So that is the point. So now we will discuss what are the methods to use to estimate the growth. So what is the moral of the discussion is that estimating future growth is not about guesswork. It's about analyzing the trend, economic condition, company potential. Get it right and you will unlock the true value of any investment. Now what are the methods used to estimate the growth? Now we understand that what are the factors influence the future growth rate, why we need to estimate the growth, what are the three common methods to estimate the growth. But let's talk in real how to estimate the growth. So friends, why do we estimate growth? Because when valuing a business we need to estimate how fast its cash flow will grow in the future. But here is the catch, no one has crystal ball. So we use different method to make realistic prediction. There are three common method. The first method you will say is expert estimation. You know what it means? So one way to predict growth is ask the expert. So company management, experts like company management. So they know the business inside out, but they might be overly optimistic. Yes. So one point is that they might be overly optimistic. This is one drawback, right? They might be overly optimistic about its future. So the second method we have is the analyst estimate. Company management, right? Analyst estimate. Analysts study industry trend and make projection, right? But their prediction may still have some biases. Some biases can be there in their prediction. So always take expert opinion with a pinch of salt. Company estimate from multiple sources before making a decision. So you may ask company management, you may ask consensus estimate, you may ask analyst, and based on the take prudent decision based on whatever output you are getting. The second method is called the survey, right? Survey. Another way to estimate growth is by conducting survey. So what is the meaning of survey? This investor, right? Investor, analyst, market participant are asked, what is your expectation for future growth, right? They have been asked that what is their expectation. They were asked their expectation for future growth. So why is this useful? So investor often has a realistic view of the expected growth, right? They have the realistic view. Even though they may have different discount rate, their growth estimate usually fall within a narrow range, which is just 4 to 6% for real estate cash flow. The challenge is that survey depends on who you ask. Different investors may have different risk perception, leading to varied response, right? So this is another point which is called survey, right? Now let's talk about the impact of rent control. What is the meaning of impact of rent control? Ever heard of this term rent control? It is a government policy that put a cap on how much landlord can increase rent. So basically impact of rent control means what? It is a government policy which put cap. Cap means limit. It put a cap or it put a limit on how much government can increase the rent. Sound goods for tenant, right? But here is how it affects growth estimate. The first thing is lower predicted growth, lower growth prediction, which means what? If a property owner can't raise rent freely, the expected cash flow growth is restricted, right? Second thing is decrease property value, right? Decrease value, here you can see, right? Decrease property value, which means since future income is capped, investor may pay less for property today. And the third thing is policy uncertainty, right? So policy is quite uncertain. So government can change law anytime, making it harder to predict long-term growth. So the key takeaway is that government regulation directly affect how we estimate growth, especially in industry like real estate, right? So impact of rent control, it very well, that because of the low predicted growth rate, because of the decreased property value, or because of the unpredictable change in government control law, so all these factors add up to the point that government regulation directly affect how we estimate the growth, especially in rental business like real estate. So the big lesson is that no single method is 100% accurate. So we have talked about the three method here, right? The first method we have talked about is asking the expert estimate. Then we take the survey, and third method we have seen that how the government policies can affect our future growth rate. So the overall big lesson from this discussion is that moral story is that no single method is 100% accurate. A smart analysts use a combination of expert opinion, survey, market condition to make informed decision. So final thought is that DCF valuation is only as good as growth estimate you put in. Be realistic, cross check multiple sources, and always consider external risk. That's the point. Now let's talk about the estimating the growth pattern. How do we estimate the growth pattern? Let's talk about it now. So friends, Today we are diving into growth pattern in DCF valuation, a crucial concept for estimating future earning and cash flow. Why does this matter? Because understanding a company's growth pattern help in selecting the right valuation method. So first of all, we know what is the meaning of growth pattern. What is the meaning of this so-called growth pattern? You know it very well. Think of a company like a growing plant, right? You can think of them like a growing plant. So some plant grow steadily, some grow moderately fast, and some shoot up like rocket. Similarly, business have different growth pattern. The first kind of pattern you can see is called a stable growth. What it means? The company is growing at slow and steady pace, matching or slightly below the economic overall growth rate. So suppose this is the economic growth rate, so the company growth rate would be like this. Either it is matching or it is slightly below, right? Think of well established company like utility provider, or you can think of the large FMCG brand, right, that don't expand rapidly but are reliable. So this is called a stable growth. Yes, they don't expand rapidly, but they have a stable growth rate, right? So some utility provider you can think of, or FMCG brands. Some have moderate growth, which means the company is growing a little faster than the economy, right? A stable growth means growing at a slow and steady pace. So single word we can say slow and steady pace. And moderate growth means what? Company is growing a little faster than the economy, typically 8 to 10% above the nominal growth rate. And these are the firm in expanding industry with solid demand, but still some level of competition is there. So demand is solid, quite solid, but competition is there. This is called moderate growth pattern. And the third kind of growth pattern is high growth pattern. What it means? Like this is where company is skyrocket, growing much faster than the economy. So let me give you some example. Like you can think of some startup. You can think of some startup. You can think of some tech expanding sector like AI, artificial intelligence. You can think of some e-commerce, right, or renewable energy. They fell into this category. So the key takeaway is that growth pattern help investor predict how long a company can sustain high growth before it slows down. I hope this is clear now. Now question is criteria for choosing growth pattern. How do we decide? How we choose the right growth pattern? Right, so three growth pattern we have just discussed: high growth rate, moderate growth rate, and the first one is the stable growth rate. So the question is, how do we choose the right growth pattern? So criteria for choosing the growth pattern, what it is? Not all company grow the same way, so we consider the current earning and revenue growth level, which means how fast has the company been growing recently. So when I say current earning and revenue growth pattern, it simply means how fast company has been growing recently. How fast the company has been growing recently. Second thing is the expansion history, which means has it consistently grown or is it short term boom. Third thing, we look at the industry trend, means some industry have natural limit to grow while other evolve rapidly. Let me give you some example to make it more clear, right? So for example, you can think of the steel manufacturing company. They may have a stable growth. A healthcare firm with new medical technology, they might see some moderate growth. And a startup in AI driven banking solution, there could be high growth model. So the question is which valuation. So now model selection we came to know, right? Stable growth, moderate growth, high growth, right? So now the pertinent question is which valuation model should be used. Yes, this is now the question. Which valuation model? Which valuation model, right, should be used? So choosing the right DCF model depends on company growth stage. So if it is stable growth, so we use a steady state model. Right, with a constant growth rate. If it is moderately growth, means a two-stage DCF model is used. We will discuss it. What is this two-stage DCF model? We will discuss it. And if it is high growing, right, then what we'll do? We use a three-stage or n-stage model or multi-stage model to capture rapid expansion, followed by a transition to stable growth. So think of it like a race. High growth company is sprint in the beginning. High growth company is sprint in the beginning. Moderate growth company jog steadily, and stable growth company walk at a constant pace. That is why for a stable growing company, a steady state model; moderate growing company, two-stage DCF model; high growth company, three-stage or n-stage model. Right. So the big takeaway from this discussion is that estimating growth is not all about guesswork. It's about analyzing past trend, market condition, industry cycle. The right growth pattern guides the investment decision and help analysts choose the best valuation model. Now let's switch our focus to the next point, which is regarding company growth and competitive advantage. This is the point. So friends, ever wondered why some business dominate for decades while others fade away? Let's uncover the secret behind business success and survival. So let's talk about what gives company an edge. What give some company an edge? Think about Apple, Coca-Cola, Google. Why do they stay ahead with others while others struggle? The reason is brand power, right? Brand name. You can see it written here. Some I'm talking about company like Google, Apple, Coca-Cola, because a strong name builds customer trust and loyalty, right? This is the point. Then we have cost efficiency. Second point, they can be reason. So basically, question is why do they stay ahead? We are answering this question. So the first answer to this question is brand power, brand name, because of their brand name. Second reason could be cost efficiency. What is the meaning of cost efficiency? See, if a company can produce at a lower cost, it can keep price competitive. And the third reason you can see is the first mover advantage. This is the advantage, first mover advantage. What it means? That the first player in the new market often gain a head start, but it does not last forever. So the reality check is that these advantages are not permanent. Over the time, competitor catches up and the edge falls, edge vanish. You can see written clearly, right? You can say reduce manufacturing cost. It may vanish gradually over the time. Now the role of legal protection. This is called legal barrier. So some company enjoy exclusive legal through license and patents. Imagine a pharma company that develop a new drug. So this pharma company had developed a new drug, right? So it enjoy high profit until the patent expire. Once a competitor can copy it, price drop and growth slows down. So what we learned, that legal advantage can disappear overnight. So company must plan for life after exclusivity, right? Now there is something called two-stage growth process. What is the meaning of this two-stage growth process? So business follow a two-stage growth journey. So first of all, initially high grow. Initially the growth is high, which means when they have an age, like let me give you some example. Suppose unique product is there, right? Or a strong brand is there, or patent protection. So in this case it has high grow, right? Stage 1 is a high grow, which means when they have an age, unique brand, right? Unique product, brand, patent protection. And second is is called stable growth, which means as competition increase, growth slow, they settle into a steady pace, right? So this is called two-stage growth process. Initially high growth followed by stable growth. Let me give you an example. You have heard about Tesla, right? Tesla has first mover advantage in electric vehicle. They have the first mover advantage in the electric vehicle, but now as more company enter the market, it grow will stabilize. That's the point, right? Now what help company stay ahead? The first thing is the strong brand. Just now we are talking about innovative management, right? Innovative management. Then we have high entry barrier. However, no company can completely stop competition. They can only slow down the erosion of their advantage, right? That's the point. So these are the point. We have just talked now entry barrier, right? Let me talk about this entry barrier once more, right? If industry need huge investment or advanced technology, few competitor can enter. This is called entry barrier. Then innovative management. You can see effective management here, which means that great leader keep exploring new market and opportunity. And brand, strong brand like McDonald, right? Consumer goods giant like McDonald, right? They sustain long-term growth because of customer loyalty. Now let's talk about the approaches to the discount flow model. In this particular, there are three approaches we will discuss in detail. So in this particular flow diagram, you can see it, you can learn it. So what is the big takeaway from the previous discussion is that a company competitive advantage is never permanent. Understanding when a company will slow down help investor make better decision. Now the image present a decision flow chart for approach number 1 to DCF, which is used to estimate the value of an investment based on future cash flow. Let's break it down step by step. So what is the first step? The first step is, can the cash flow be estimated? You see it is written here, right? Is it possible to estimate the cash flow? So the first question to ask for is it possible to estimate the cash flow? If it is yes, if it is possible to estimate cash flow, the next step is to analyze the type of leverage used by the company, which type of leverage the company is using. And if it is no, it means if the cash flow cannot be estimated, then DDM we will discuss, dividend discount model is used instead. So basically, can we estimate the cash flow? If yes, If yes, then the next step is to analyze the type of leverage used by the company. And if no, if you are not able to estimate the cash flow, then we can use DDM. Now, if we talk about the types of leverage, there is something called, if cash flow can be estimated, the next step is to identify whether the company leverage is static, which means, when it says static, it means, fixed leverage structure. It means, fixed leverage structure leading to the use of FCFE. We talked about this FCFE, fixed leverage structure, FCFE. And dynamic, if it is dynamic, dynamic means changing leverage over the time, so leading to use of FCFF. So if cash flow is changing, right, if leverage structure is changing, this is called FCFF, then we use FCFF, right. So the key takeaway from this discussion, from this diagram, is that if cash flow can be estimated, the DCF method is applied based on the company leverage structure. If cash flow cannot be estimated, the DDM is alternative approach. A static leverage company use FCFE, while dynamic leverage company use FCFF. We will discuss in detail what is FCFE, what is FCFF, how they are used, but this is very important.